This video is sponsored by Morning Brew. Click the link in the description below to start getting your summary of the daily news today. Cryptocurrency as a whole has certainly come a long way, from its humble origins among niche cypherpunk communities to today where it seems every trading platform is trying to add some crypto functionality. Recently, however, the space has gotten a pretty bad reputation. From numerous rug pulls where investors' money is taken out of newly created systems, to the brutal onslaught of NFT projects peddling pretty bad art, there's a reason many believe that there's more hype than substance to the space. But while the idea of buying the latest iteration of the Dogecoin meme and seeing your money go to the moon has somewhat died down these days, what about that core DeFi, or decentralized finance functionality, that started it all? After all, the basic idea of the Bitcoin white paper released in 2008 was for a peer-to-peer system for transferring funds outside the influence of financial institutions. And while the term DeFi itself wasn't coined until 2018, it's now possible to do everything from invest to lending money on the blockchain. Does this side of crypto hold more promise than just buying the latest meme and seeing your funds grow to millions? Well, while there are strong arguments for certain decentralized systems at a high level, in practice, there remain many problems with how DeFi operates, some of which greatly reduce the likelihood of widespread adoption. Now, that's not to say that long-term we might not see something emerge out of the area. And even these days, there are plenty of people that find great utility in the DeFi platforms. But claims that the current banking system is on its way out the door are likely premature, if not totally off base. Why? We'll dive into that and more on today's Plain Bagel. Our current financial system operates under what you might call a hub and spoke model, where financial institutions, the hubs, facilitate every transaction in the system between the spokes, us if you will. This obviously gives banks a lot of control and power. Outside of central banks, who themselves influence the very value of the currencies we operate on, financial institutions dictate what rates you pay, what you earn, and can even track and block your transactions. And of course, most institutions scrape fees off of every transaction that goes on in the system, even if it's between two end users. There are obviously a number of issues with this, and centralizing power in this way, while efficient at moving money around, can cause problems, as we saw in 2008 with excessive risk-taking from institutions that were deemed too big to fail. Add in that many underdeveloped nations face rampant corruption and monetary issues, and there are many places where the traditional financial system falls well short. To some, this is where DeFi shines. DeFi has attempted to create an entirely new ecosystem where consumers can interact with other end users directly, regardless of where they are or even who they are, all the while bypassing the influence and control of the government and large financial institutions. I'll quickly describe DeFi at a high level, but obviously I'm skipping over a very many number of details here. As you probably know, the foundation of this functionality is the blockchain, a distributed ledger maintained by numerous nodes and validators as opposed to a single financial institution or server, meaning no one party has control of or gatekeeping authority over transactions on the system. Rather than being facilitated by a middleman, DeFi functions rely on what are called smart contracts to outline the rules of interactions. Simply put, smart contracts are small programs that themselves are hosted on the blockchain, and they have allowed people to create decentralized applications, or dApps as they're called, which facilitate everything from exchanging your cryptocurrency to buying insurance. Now, while the Bitcoin blockchain is really what popularized cryptocurrencies and the idea of being able to hold and send digital currencies directly to other users, most dApps are actually hosted on the Ethereum blockchain, given that Ethereum, by many standards, offers more smart contract functionality. It was actually Ethereum developers who coined the DeFi term in 2018. So, what can people do through DeFi? Well, quite a bit actually. For one, those who have cryptocurrencies on hand and want to earn more cryptocurrencies can effectively deposit them into the system in the same way you might contribute money to a savings account to earn a return. You can either stake your cryptocurrency, basically helping to support the blockchain as a whole with your funds. You can lend it out to borrowers to earn an interest rate on the money that you have, or you can contribute your funds to a capital or liquidity pool, all of which offer you a return for putting money into the system. This is what gives DeFi its firing power. Funds contributed to the system are used for a number of different functional or financial purposes, while depositors earn a return in the form of interest, fees, or at times promotional rewards from certain platforms. In fact, some active investors carry out what's called yield farming, where they essentially hunt for the best rates and frequently switch their crypto into different functions. Although this can be seen as a risky approach, especially in situations where you're getting a new type of cryptocurrency. Meanwhile, on the demand side of things, you can borrow money through DeFi lending platforms, buy insurance to protect you against certain DeFi events, such as a hack. You can exchange your cryptocurrency for other cryptos or fiat currencies, trade derivatives, gamble money, and many, many other functions. Clearly, the functionality of DeFi has expanded well past the simple moving of money around, and people have found a number of benefits to operating on the system. Returns from things like yield farming can at times be high for simply providing money into the system. Arrangements can be entered without any sort of paperwork, which obviously can take time traditionally. And of course, everything can be done anonymously and without regulation, for better or for worse. There's also the fact that the blockchain is immutable or permanent. Data added to the blockchain can't really be edited after the fact, making it immune to certain types of hacks. You can see how some of this has an appeal. And indeed, DeFi has grown pretty rapidly over the past few years as more users hop on. Total value locked for Ethereum, the value of cryptos deposited into the system, if you will, has jumped from just over $600 million at the beginning of 2020 to over $110 billion more recently. Now, that growth is certainly impressive, but it is firstly worth noting that it does remain peanuts compared to the larger financial system. According to the Bank of International Settlements, total global bank assets are roughly $101 trillion. So DeFi only represents a rough 0.1% of the entire banking system. JP Morgan itself is valued at roughly double the entire DeFi market. Now there's a chance that DeFi continues to grow at these impressive rates and challenges the traditional system. But this is where we start to get into some of the issues with how DeFi works, because as impressive as these milestones achieved have been for DeFi, there's a reason that most people will still likely go to a regular financial institution to take out stuff like a mortgage. For one, DeFi as a whole is fairly inefficient and cumbersome, at least when it comes to processing data. Maintaining the blockchain consumes a lot of power, with a single Ethereum transaction consuming roughly 60% more electricity than 100,000 Visa transactions. Building applications on Ethereum can also be pretty clunky because it essentially involves stringing together multiple small programs rather than being able to build a fully self-contained program, given smart contract limitations. It would also ironically appear as though those middleman fees that we've come to love in the traditional system are actually an important part of DeFi as well, with many transactions requiring you to pay what are called gas fees, effectively a tip to miners of the system that for even slow processing speeds can equate to over $10 a transaction. And the more complicated your DeFi function, the higher your gas fees will be. Now, importantly, there have been systems developed to try and circumvent these timing and costly issues, including layer 2 scaling and sidechains, both of which essentially involve processing data outside the Ethereum blockchain itself, but this has led to a saturation of different options for carrying out basic DeFi functions. So it's hard to know which functions will end up sticking around, and obviously doesn't make for the most efficient of marketplaces. Certain functions have also had to make sacrifices in the name of keeping things on the blockchain. Loans are a great example of this. Outside the fact that interest rates for DeFi loans are very volatile and rapidly changing, there's really no way to assess the risk of borrowers in a DeFi system. Because of this, most dApps require borrowers to over-collateralize their loans, depositing more money into the platform than they're actually taking out. This ensures that lenders have security against someone making off with their funds, but greatly reduces the use cases for loans on DeFi. And given how important loans are in the current monetary system, that's a big hiccup. There's also, of course, the risk that comes with DeFi platforms. This is the plain bagel after all, we have to talk about the risks here. DeFi is, after all, an early technology with many functions being figured out in a brutal trial and error process. It's why a lot of crypto enthusiast sites themselves concede that DeFi is a high-risk area for adopters. Why? Well, firstly, there's just the sheer volatility of many cryptocurrencies, which are a necessary component of these transactions. Ether itself, the cryptocurrency supporting Ethereum, lost almost half its value in just a few months at the end of 2021. So you can imagine how disruptive it would be to operate a DeFi system off such a volatile asset. Now, many services do circumvent this by relying on what are called stablecoins, cryptocurrencies like Tether and DAI, which peg their value to the US dollar. But outside the fact that some of these platforms have lied about the amount of actual US dollars backing their value, stablecoins obviously connect DeFi back to the US financial system that it is intending to replace. Consumer protections are also, for many functions, non-existent on DeFi. Because when you know it, sidestepping regulators also means operating in a space with no regulations or consumer protections. If you lose your cryptocurrencies because someone scammed you, hacked your wallet, or otherwise gained access to your crypto assets, there is absolutely no recourse for getting your coins back. At best, you might be able to block the hacker out of using certain platforms that agree to help you out. And even then, the only chance you'll really get your crypto back is if you convince the hacker to effectively be charitable. And while the blockchain itself is pretty well protected from hacks, there are plenty of vulnerabilities that arise during various DeFi functions, which is why we always hear about crypto hacks despite the blockchain itself being pretty resilient. Part of the issue here is actually the blockchain's permanence. Because smart contracts are human-coded programs, they can sometimes have bugs that will either lead to the service crashing at times, or lead to holes in the security of that platform that hackers can exploit. And because things on the blockchain can't really be changed, there's no way to patch or update this faulty code. Things have to be replaced, which leads to a very tedious and slow process for addressing vulnerabilities. Finally, in many ways, DeFi has replicated many of the problems of the system that it's looking to replace. As mentioned, many DeFi functions have tied themselves very closely to the US financial system, meaning central banks and non-central banks still have influence over DeFi operations. And we've seen that there's the development of certain things that people came to hate in the US financial system, such as DeFi derivatives. CDOs, or collateralized debt obligations for one, have in some areas become an important part of DeFi functions, which is a little ironic when you consider that these securities were at the core of the 2008 financial crisis. Despite what enthusiasts might say, DeFi also really hasn't done a good job of decentralizing power. Sure, once you get past the massive learning curve of crypto, it is in some instances more accessible than traditional financial systems when it comes to stuff like credit scores and whatnot. But having money still gets you the furthest in the system, and early adopters are put way further ahead than late adopters, allowing people to buy more control of DAOs, pay more in gas fees to get faster processing, build the largest mining farms for the biggest reward of crypto assets, or just buy the most assets yourself. Now, to squeeze two shoutouts into a single video, Patrick Boyle actually recently shared with me a great piece that goes over this issue more in depth, called Line Goes Up, the problem with NFTs by folding ideas. You might have seen it circulating around, it's done really well for itself, and it's a great piece that, while more critical than I'm willing to be here about the system, highlights why power distribution isn't exactly equitable on DeFi. So I've sort of just spat out a lot of high-level issues with DeFi, but you can see that they are important hurdles for the space. And really, my goal here isn't to demonstrate that DeFi is worse than traditional finance. Of course, there are many deep-rooted issues with the traditional system, but problems with the current system don't alone justify the new one. And as technically beautiful as DeFi has become, it needs to be practical for it to really see wider adoption. Maybe it will get there. I'm not stating that peer-to-peer finances with or without the blockchain won't continue to see growth. But people who say banks are already on their way out the door really don't understand the scale of the current system and how in some places it does do better than DeFi. Now, obviously, no one can predict the future, including myself. I am, after all, a dirty financial professional who has a conflict of interest to keep the poor's money in bank accounts. I'm not actually a banker, but it's just to say I really don't mind if DeFi does well or not. I actually think it's great to have competition for how we do things and to challenge the system as it exists. It's just to give a bit of pushback against enthusiasts who might say that the DeFi revolution is an inevitability and a good reason to buy into cryptos now. That might not necessarily be the case in the long term. A big thank you to Morning Brew for sponsoring today's video. As we hopefully demonstrated, DeFi is just one example of how quickly the financial landscape can change and adapt to new technologies. And if you're interested in keeping a pulse on everything going on in the world of finance or business as a whole, Morning Brew is a free service that sends out an excellent daily newsletter summarizing tech, finance and business news. It was a friend who originally recommended Morning Brew to me, and I've really liked reading them because of all the cool tidbits of information they squeeze in, like how the average NFT is actually only held for 48 days. But if reading ain't your bag, they actually just recently started their own YouTube channel. They have a whole bunch of different videos covering everything from what inflation is to the evolution of the video game industry. And just like their newsletter, the videos are witty and entertaining. One of theirs that recently caught my eye was their most expensive NFTs piece, which covered the 10 most expensive NFTs ever sold. Spoiler alert, a lot of them came from the same sort of lame collection. So if you want to check them out, use the link in the description below to go visit their channel and subscribe for the low cost of, well, free. And of course, you can always sign up for their newsletter if you want more content as well. Thanks again, Morning Brew, for the support.